insights that will shape the day. This is BBC World News and Asia Business Report.
Oil dips under $30 a barrel. Energy giants scramble to cut jobs and investment. And we look at the business of giving, where being non-profit doesn't mean you can ignore your balance sheet. Hello Asia, hello world. Glad you could join us for this midweek edition of Asia Business Report. I'm Rico Hizon in Singapore. Continuing concerns about China's slowing economy has seen oil prices dip below $30 per barrel in New York for the first time in 12 years. It marks a seventh day of losses, extending the relentless sell-off that has wiped almost 20% of prices so far this year. Light sweet crude at $30.49 per barrel, Brent crude at $30.74. Well, it's hit profits at the British oil giant BP, which is now cutting 4,000 jobs worldwide. 600 of them will be from its North Sea operations. And Brazil's oil giant Petrobras is massively scaling back its investment plans by $32 billion. It is the company's third cut in 6 months. So what about the impact in Asia? Let's speak now to Tama Churchouse, joining us now from our Hong Kong studios. Tama, thank you so much for joining us on Asia Business Report. Plunging to levels not seen since 2003. How concerned are you that we've seen oil prices this low?
It is pretty concerning, Rico, to be honest. It's not surprising, though, to be honest. We've still got excess supply over demand, and that's still going to weigh over prices in the short term. I don't think China is that big of an issue when it comes to oil, as I think people are making out. China oil demand is still likely to eke out positive growth this year. It's still really just a matter of two factors, that is excess supply, and the second element, of course, is the ongoing strength of the dollar, which is also going to push the oil price down.
But these depressed prices, Tama, have stressed the energy sector around the world and also the Chinese oil companies. How does this affect Asia's consumers and countries still subsidizing oil prices?
Well, to be honest, it's fantastic for companies that are subsidizing countries that are subsidizing oil prices, because as we saw in Indonesia, low oil prices give you an excuse to actually start to remove those subsidies. It's going to obviously help government balance sheets. It's great for the driving consumer. It's going to be disinflationary for prices, obviously. For companies, it's a completely different matter. With BP, you mentioned earlier, further job cuts. We're going to see further capex cuts. All of these companies are trying to trim costs as much as humanly possible to try and get through this extraordinarily low oil price period. A lot of these companies which were marginal at $50 are going to really, really struggle sub $30 for sure. Morgan Stanley saying it could go another 50% down to $20. So we're going to see more blood in this sector for sure.
Many oil and resource companies are depending on China for their profitability. With the China trade data out shortly, are you expecting the numbers to show further declines in exports and imports?
Yeah, we're going to see declines on both. I suspect we're going to see a larger decline in imports than exports. It's not great. It's going to be leading to a bigger trade surplus for China. I don't think the impact on equity markets is going to be particularly cognizant. We're not going to see much unless it's a huge surprise to the negative or the positive, obviously. But I don't think that investors are really looking at trade data that heavily at this stage. I think oil is actually a much bigger weighing on their mind more significantly.
Thank you so much for your insights. Joining us from Hong Kong, Tama Churchouse. Well, among China's most popular imports are Hollywood movies, and how